What is going on, my friends, on the interwebs? We're talking about the Book of Faces. We're talking about the tubes of you. All right, so here's the deal. Things are slowing down just a little bit. They are. They're slowing down. It is what it is.
Hated it.
I hate it as much as you do. But we kind of knew this was happening. This perfect storm was developing here, where this time of year is pretty typical for things to slow down anyway. But then on top of that, what we've got now is we have a new cycle of buyers. A new cycle of buyers are here. A lot of the people who stayed at it for a long time, they've moved on, they're renting, they're watching the market from a distance now. They won't be engaging for 8 to 10 months. I do think when that group re-engages, it's probably when we come out of this. So what's going to happen in the meantime? What happens in the next 6 to 12 months as rates sort of teeter? We're going to look at rates in just a second. You're going to hear the word recession a lot. You already have. You're going to hear it a lot more because we're going to likely be in a technical recession. We're going to actually be in a recession. The rate sheet or the rate graph that I show you from the Fed, we're going to start to be gray in the actual current time frame on that chart. And so that chart grays out whenever we are in a recession. So we are going to technically be in one here very soon. I'm going to talk about that in a second. We are going to look at, what's going on with opportunities. What are the opportunities here? What are people doing to succeed? How are people winning? Home buyers, home owners, how can you win here? Home buyers, obviously this is the best time to buy we've had in a couple of years, as far as just your ability to negotiate, your ability to just go and write an offer. We're seeing things we haven't seen in a long time, pretty bleak open houses. I had an agent text me over the weekend, hey, I had 0 people at my open house, 0. And it's a pretty well-priced home in a relatively nice area. So you don't expect that. But when we have, June, school gets out, people start going on vacation, buying gets kind of pushed to the back burner. It becomes more important, a little later in the summer as people want to be in their homes before school starts when you're moving to a new area, or regardless, just before you get into the school routine, you want to be in your home and have everything settled. So we tend to see a little bit more activity towards the middle end of summer. The beginning of summer here in San Diego, it's kind of always like this. So things have slowed down. They've slowed down a lot. Buyers are just not that excited, is what I've noticed. Buyers aren't very excited, which is creating a huge opportunity for the buyers who are. For the buyers who are coming at this market going, hey, let's go. I'm ready. I've got guns blazing. I'm ready to go. Let's write some offers. Man, will you have the attention of this listing agent? I mean, if you are a buyer, you're writing offers right now, you have their attention. And what a great thing to see for buyers. Obviously, I'm advocating for buyers here. Sellers, nothing against you, but I advocate for buyers. I represent buyers. So as their lender, no, not representing as an agent. So, this is a good situation for buyers. Let's take a look at a couple things, all right? We're going to look at this. Derrick Evans here, VA Home Loan Specialist, NMLS 155010. Let's get me out of here. Let's get this out of here. And let's dive into some of this data. Let's look at some of these things that are going on right now. Most people, if you're in the industry, this is the winter I warned you about like 9 months ago when I was like, hey, save your money. We can't boom like this forever. It does at some point have to come to an end. It has to slow down a little bit. That was really before we knew what was going to happen with interest rates. Interest rates have obviously gone up quite a bit. Now we have the cyclical slowdown on top of the macro slowdown, and it's going to feel weird and ugly here for a little while. I think we might have a month or 2 or 3 where it's just like, what is going on? And that's just part of the process. What follows extreme booms. So the Fed GDP tracker shows the economy could be on the brink of a recession. It is. Let's call it what it is. Atlanta Federal Reserve's GDP Now tracker is pointing to an annualized gain of just 0.9% for the second quarter, down from 1.3 estimated less than a week ago, with first quarter growth down 1.5%. A second consecutive quarter of negative growth means rule of thumb definition for recession. So it's back-to-back quarters of negative growth is what technically signals a recession. So we will technically be in a recession when this quarter is over at the end of the month. That is my prediction here. Also, we're going to take a look at interest rates. That's what's going to be next. So just kind of expect that. You're going to hear recession. Remember the news. They want you to be scared. They want you to do those things. Just be smart. Always be smart with your money. Don't spend it on things you don't need. Be smart about it. Always save money. Try to live within your means. Those are things you should always do. But yes, right now in this type of situation, take a look at some of those things. Are you spending money on things you shouldn't be? If you're in the industry, a couple of things, if you're a realtor, if you're a lender, don't go do new marketing campaigns right now. There's no point to spend money on stuff that's just going to fall on deaf ears. It really doesn't make sense right here. Don't go do new marketing campaigns. If you have marketing you've been doing for a while, it makes sense to peel it back 50% or something, because there's diminishing return when the sentiment is what it is right now. And the sentiment isn't great, and this is what I've been watching for. This is what we've been talking about, what we've been paying attention to. The sentiment in the marketplace is not where you want it to be. It is one of kind of wait and see. We have a wait and see sentiment right now, which isn't going to do anyone any good. But it is what it is. And people tend to do these things. The sociology involved here is really interesting stuff. The people tend to do things in lockstep. Even though everyone thinks they're making their own decision, you're doing the same thing that everyone else is. And so I think it's the people who kind of step outside of that are going to really get the benefit from this. So we've been watching this reverse head and shoulders here. And we had it was forming just perfectly. And then yesterday just killed my hopes and dreams, right? But today we bounced back into the range. This could still be sort of a lopsided reverse head and shoulders. So it's still intact. This reverse head and shoulders is still intact. We need to see the week finish strong, because here's what our big risk is at this point in time. This is what the big risk is to the marketplace, is if for some reason either the Fed starts selling bonds or anything happens that causes rates to get a lot worse right here, that would really, really be impactful. For example, let's say we lose 100 basis points on this chart, which could happen in 2 days. It could happen in 1 day pretty easily. If the Fed says, hey, we're going to sell bonds, if the Fed actually does push the button and sell some bonds, anything like that, if they do it, rates go up, we're going to see it. It's going to hurt. It's going to hurt. It's going to really hurt. So right now we are more fragile than we've been. We're exposed. The market is exposed right here. But if you look at the macro data, and I'm going to do this, I'll probably wait to the end of the week. If you look at the macro data, I was just going over with just got off the phone with one of the top listing agents around. And what I was asking him about was, how does the data look? How are you seeing it? He said, it's gotten a lot worse in the last week, 10 days, week to two, let's call it. But everything I have in escrow is strong. Places sold quickly. He said the numbers and the data that's coming through for new listings, for pricing, he's like, everything still looks strong. We're probably going to see it weaken a little bit more, but right now still looks strong. So we haven't really seen this new wave of buyers, the effect, the function of this new wave of buyers. And when I say new wave of buyers, I mean people who've been pre-approved in the last month. If you've been pre-approved in the last month, you are shopping for homes in a different market than people, prior to that. It's just a completely different market. You have more inventory to choose from. You have sellers that are actually coming after you. You have sellers that are willing to negotiate. If you're a buyer in this market, you can go out. This is finally a market where a buyer could just go out and just make an offer. Oh, it's listed for that? Let me write you this offer. But still make it strong. Still make it strong. Be organized. Get your pre-approval letter. Send your proof of funds. Do all the things. But you have the opportunity to write an offer, and that seller may not have another offer. We haven't seen that for years. That is good for buyers. So let's keep that in mind as we look at some of the other opportunities here. Okay. So still intact. Doesn't look great, but doesn't look terrible. It's not what I was hoping for. I was really hoping that this would be the bottom here and we would catapult higher from there. We haven't. But we don't have any real reason. There's no real reason to believe that this is the start of a new downtrend, even though it kind of looks like it. We don't have a real reason to believe that. So I'm going to just keep letting this play out. The next 2-3 days are really going to tell us a lot here. And so we're going to keep a very close eye on this. We really want this to stay strong. So we talked about the GDP tracker, rule of thumb definition of a recession by the end of this month. It's happening. Okay. We're going to be in a recession. Recession will begin. It will trigger a few things. Notice, though, Last couple of days, even though this has become very evident, the stock market is sort of rallying a little bit. We'll just keep watching that too, because sometimes, when the bad news comes out, okay, so like if you're waiting for really bad news to come out, that's actually a lot of time what signals the bottom, because people will capitulate. Oh, we're in a recession officially. Oh my gosh, honey, go sell the 401k. Sell the stocks tomorrow morning. People will capitulate. Go, we're in a recession. I know what's happening from here. It's going to get so much worse. But markets know that, and they're looking for liquidity to change the direction of the market. We're already down quite a bit. Remember, we were looking at that on the NASDAQ here, and we measured this because it was just so crazy. This is a daily chart right here in the NASDAQ. And if we go top to bottom, I think it was 30%, 31%. So that's pretty hefty, guys. I mean, that is pretty hefty. There's been a lot of pullback in the markets. That doesn't mean that there can't be more, but it just means that there is, when you hear recession, don't necessarily buy into the mass psychology that means things now are going to get so much worse. Remember what happened the last time we had a recession? You know what? We got to pull this up. Fred, median home values. I should have probably have this up already, but it is what it is. And the reason that this graph is good is because it puts this in perspective. You're going to hear the word recession a lot. See those gray vertical lines? Those are the recessions. Now, the most recent one is all the way over here. This line right here. It's so small you can hardly see it. That was COVID. Look what happened. Look what happened. So the recession doesn't necessarily mean the economy is going to tank or real estate values are going to tank. It could, but it doesn't necessarily mean it's not a foregone conclusion. The overall sentiment, the overall psychology of the market is what matters. Because at the end of the day, this whole thing is a house of cards. I mean, money's just pieces of paper, right? Stocks are just pieces of paper. Bonds are just pieces of paper. You want me to keep going? Gold is a yellow rock. Okay? I mean, at the end of the day, this is all a conspiracy that we've agreed to. The whole economy, money, everything. So it doesn't have to work any particular way. It works in the way that we all collectively agree that it works. And the market is never wrong. The market has spoken, for the most part, about what happens in recessions. You'll notice when you look at these, almost every time real estate values go up, except for the Great Recession, which was caused by real estate, where we saw a big downturn right here. But of course, it didn't take long for that to recover and then some. I mean, look at this. If you bought at the top in 2007, where the median price was $257, so that was 2007. It took you about 6 years. In San Diego, it was closer to 10 years, but about 6 years for you to get back to that level. And since then, it's gone up a massive amount. Huge amount, almost double. So when these recessions happen, I just want you to note, look at this. In most cases, these recessions, we either see a small increase, a small decrease in prices, or we see a big decrease here, but all of which are followed by runs up, especially the last two. Look at the last recession, okay? Bottoms out here in the recession, then boom, real estate values go crazy. Another recession, boom, real estate values go crazy. So don't just hear the word recession and assume that means anything. Know that there are bigger factors at play. There are people with bigger money than you, and they're making moves, and that's what we need to follow. That's what we really need to take a look at. Does anyone believe these people? World Bank slashes global growth forecast to 2.9%, warns of 1970s style stagflation. Okay, 1970s style stagflation. Guess what? We've got graphs of the 70s. What happened? Well, we had a couple recessions in the 70s. Actually, yeah, that one was until 1980. So in the early 70s, had one in the mid 70s. What happened to real estate values during the 70s? You know what? Let me make this easy on you. There's 1970 to 1980. So their warning is of 1970s style stagflation. That is the chart for median home price, home values in the United States in the 1970s. It looks just like the macro chart, doesn't it? And this is why real estate's the chart that you want to be invested in, because it goes up and to the right. Yes, are there sometimes course corrections that get us back to macro trend lines? Of course. But it goes up and to the right. And that's what you want all of your investments doing, up and to the right. That's what real estate does. So we hear this word recession. You're going to continue to see negative articles. You're going to continue to see these things. But let's watch a couple things. Let's watch what the big boys do here with stocks. Are they buying the dip? Are they turning this thing around? There's been a lot of selling already, been a lot of red already. Let's pay attention to that. Let's also make note that all of these bow tie people, all of these prognosticating academics, they're always late. I was telling you about inflation and hyperinflation that we were experiencing a year and a half ago. They knew about it then too. They weren't talking about it. Who knows why? Let's not speculate. I won't speculate. Why would they say it was transitory? Why'd they tell us all those things? Sure feels like a setup. And it's one that you can profit from if you're on the right side of the river. That's what I'm trying to do. I'm just trying to get people to the right side of the river. That's all. Listen, I got a boat. I can get you over here. It just takes a little bit of understanding. Housing wealth gains a record 1.2 trillion. But there are signs the market's cooling. This is actually true. There are signs the market is cooling. There are signs that there's more inventory. There are signs that there's less buyers. There are signs that the buyers who are here are not as enthusiastic. They aren't as like crazy gangbusters.
All we want to do is pump you up.
Ready to get after it and just throw money at the situation. You got a problem, throw my money at it. That's not really the way it's looking right now. Right now, it's about requests for repairs getting honored. It's about, instead of covering appraisal gap, no, you're going to bring it back down to what it appraised for. And they're getting that. So, yeah, things have changed. All things good for buyers. The collective amount of money mortgage holders could pull out of their homes, that's what this is talking about, by the way, while retaining 20% equity, rose by an unprecedented $1.2 trillion in the first quarter of this year, according to Black Knight mortgage software analytics firm. Holy smokes. So what do you do? What do you do? Here's what I've got people doing right now. I'm just going to throw this up there so everybody knows. VA Home Loan Specialist. Call me, text me, email me if you want to buy or refi. Because what's going on right now is we put 2 refis in this week already, and it's Tuesday. So people are refinancing. Why? They see the equity. They know they haven't done anything with it. People ask me this all the time. Should I use my equity? And I'll tell you the same thing I tell everybody. You can use your equity. It's not a bad idea as long as you have a plan for it. Don't just pull the money out and say, I'll figure it out later. Remember, as soon as you pull the money out, you're paying towards it. So when you pull the money out, you better have a plan for it. Have a gentleman who's able to do a refinance, a VA cash out refinance on his home. It's gone up a lot in value. He has some debt. He's going to pay it all off, save like $3,000 a month. I mean, it's crazy savings. And I told him, I said, yeah, you're going to get 4.5 now, but in the future, I will call you. When it is time to refinance, I will call you. You will do your VA IRRRL, which is a very easy refinance, and you will drop your payments even further. So yeah, there's opportunities there. Some people are building ADUs. Makes a ton of sense to build ADUs. Probably the best ROI in the existence of real estate right now because you've already owned the land. So it's a huge opportunity. In fact, I'm just going to say it right now. ADUs, building ADU on your property is by far the best use of your investment dollar at this point in time. 100% guaranteed. There's nothing better than that right now. Especially from just a standpoint of surety. You're going to get your money out of that in both ways, both in the appreciation of the property and in the cash flow. In total, the nation's so-called tappable equity. Did they say tappable? So tappable equity stood at $11 trillion or 2 times the previous peak in 2006. So some people look at this and go, wait a minute. That seems like crazy. Now they're saying tappable equity is equity, which still allows a 20% equity position. So, you're still going to refinance a cash out conventional. That's going to be 80% maximum loan to value versus like VA where you could do 100%. So it's 2 times the previous peak in 2006, which means there's so much household wealth out there, real estate wealth out there. It's crazy. Does it make sense to tap into that and do something with it? Listen, your equity does not earn you anything. It's just sitting there, right? It's earning 0% exactly. Your home will go up or down in value regardless of what you owe on it. Doesn't matter. If you owe $1 million or if you owe nothing on your house, the value of the home is going to go up or down based on the market, based on the comps, not how much you owe on it. So you have no downside to your potential appreciation by taking cash out, but you got to have a plan for it. You need to have a plan, and in my opinion, should be an investment plan or a debt consolidation plan. Those are the 2 best ways where we can look at it and we can get numbers. We can make sure it's going to pencil. We can make sure that it's worth it. And just know that if you begin a refinance and you get an appraisal done and you're looking into this and maybe something along the way doesn't work out the way you want it to, you can always cancel it. You can always cancel it. You're never, even after you sign the closing docs, you have 3 days to cancel that sucker, unless it's an investment property refinance. So you have time, you have opportunity there. What should I do with my money? A lot of things. It's a whole nother show, but a lot of things you could do right now. A lot of opportunities. This boils down to an average of $207,000 per homeowner. That's a lot. That's a lot. So there's a lot of money in houses out there right now, and I wonder what impact that will have. I wonder, will people get to a point? This is my big question for the market: is in this boom for the last decade, have people built unrealistic lifestyles? Are they spending like way out of control, or being irresponsible as a whole? Has that gotten really bad? And if you catch yourself being in that situation, the quicker you can take a look in the mirror, have that come to Jesus with yourself. Hey, we need to make some changes and start making some hard changes. The sooner you do that, the better you'll be. If you keep waiting around for it to come, keep waiting for things to go back to the way they were, and you're spending every dime you have, that is not the position you want to be in. Please don't do that to yourself. Don't do that to your family. Get ahead of it. Okay? I thought this was interesting. Sellers lowering prices, but watch for these 2 signs to fall in love with your home before you buy. First of all, this is an ad, totally. Remember, I'm telling you about how these media companies work, advertorial versus editorial. This is totally advertorial. You can see all these advertisements up here. And I just thought this was interesting. It said, as the housing market cools down, these 2 indicators can help you find a good deal. Well, what 2 indicators are they talking about, sir? Inventory numbers are on the rise. Duh. As mortgage rates have spiked, consumer-driven frenzy to buy a home has slowed significantly, a trend that is directly reflected in the number of active listings. Okay, true, but does this really watch for these 2 signs to fall in love before you buy? Inventory numbers on the rise, yes. Interest rates tick upward. So inventory up, interest rates up. They're saying interest rates will remain volatile. That's pretty interesting, if you ask me, because, what we're looking at right here, and don't get me wrong, we've seen volatility, but this is pretty darn consistent right here. This is the range we're in. Yes, it's trending lower a little bit, which I don't like. Yes, there is a pretty bullish pattern formation here, but it's overall pretty darn consistent. That's pretty sideways. So I don't know why we're saying remain volatile. Do we even know what that means? I'm not sure. But these are just, to me, this is just hilarious. It's an advertorial. There's no value in this article. I was just pointing out how silly it is, but I'll get you a link anyway. Private mortgage insurance. This is probably one of the better ways for homeowners out there who bought in the last 2-3 years. If you have PMI, very good chance you can refinance and get out of that. And someone might say, well, wait a minute, but if I have to take a much higher rate and that cancels out the PMI savings, then what's the point? That's a good point. You have to look at the totality of everything, because The nice thing is if you do have to take a higher interest rate, you at least get the tax deductibility if you're itemizing your deductions. The PMI, you don't get to write off. It's not tax deductible. So if you were paying $200 a month in PMI and instead now you pay $200 extra a month in interest and your payment stays the same, that's $2,400 a year, that you're now going to be able to deduct from your taxes that you weren't able to before. So maybe to save you $1,000 or something. It's not huge if you're in that boat, but you do need to look at all of those things when you are looking at a refinance. But a lot of people right now can get out of their PMI and they don't know it. So this is actually pretty valuable information, I think, for people out there who own a home, you have private mortgage insurance, see what the value might be. Check with your realtor who sold you the home, or do a Zillow estimate and a Redfin estimate or whatever. Just see, hey, am I in the ballpark? Because the risk for you is a $500 or $600 appraisal to find out if you can get out of there. And it doesn't cost anything to lock a loan. So with that all in mind, yes, there's opportunity there to save some money. There's no question about it. If you are looking to buy, right now is one of those times where you're going to see a lot of different answers from a lot of different banks. I just had someone call who was referred by an agent, and they were like, hey, I went to this credit union, very well known, and then I went to that credit union, very well known, and I'm just not getting the communication I need. I'm a nurse. They're not there. Listen, there's so many different elements in the mortgage business. As a broker, my goal is to offer the best possible rate with no lender fees, and I'll help you. If you're getting a great deal from someone else, I'll tell you. So email me your scenario, submit your scenario, whether you've already been pre-approved or you haven't. If you want to just get a quote, say, hey, what kind of rate could I get? This is the information I need right here. You can email me, text me this information, loan amount, the purchase price. That's what the PP stands for. Home value, if it's a refi, your approximate credit score, and then whether it's a condo or detached home. Give me that information, and I will give you everything you need to make a decision that's best for you and your family. All right. I hope this has been helpful. I look forward to seeing what happens in the next few days. Try not to be a part of the herd. Try not to be a part of the herd. That is my message right now. They are trying to herd us into a certain mentality. It is very clear that a lot of people and entities want to see blood in the streets here. Listen, don't play into it. Look at the reality. Look at what you're experiencing yourself. Be smart about what you're doing with your money. Be smart about what you're doing with your savings. Be smart about what you're doing with your debts. Tighten everything up, okay? Let's get high and tight. I hope we're that way all the time, but if you're not right now and you know it, you've been sloppy, you don't know where this is, you don't know where that is, you don't know where this investment is, where that investment is, let's get high and tight here on all that stuff right now. Right now. We don't know what's going to happen next. We don't. Recession 100% is going to be here. I guarantee it. When July hits, when we get to second quarter numbers, we're going to have recession. You're going to see it plastered everywhere. You already are, but you're going to see it plastered everywhere. They're going to try to roll a whole bunch of negative info into the marketplace. And look, it's working. It is. It's working right now. They have basically got buyers to just stop. Completely like game over. It's very interesting to watch. But I'm also watching the buyers who are engaged. I'm watching buyers who had no prayer to get an offer accepted a year ago coming into the market and making demands and getting yeses. So there is opportunity for people who are contrarians to what the masses are doing. And that is what I hope that you will be. I hope you will take this information and apply it, because knowledge without application is useless. Have a great night, guys, and I will see you soon.